everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue. Goodbye, May. Hello, June.
If we look at the performance in May,
we're clearly in a bear market. We've seen a nice little rally.
It's important to listen to what the market's telling.
We're not in the all clear here at all.
The losses this year have been the biggest on record.
We now find ourselves in a little bit more no man's land.
This is not a time when you try to chase and call a bottom, call a peak, call an inflection point.
You look to June.
We could see quite a bit more downside in equity.
Let's get the conversation started with Neuberger, Berman's Ashok, Bhatia and Cameron Dawson of Newedge Wealth. Cameron, first to you. Hello, June, and hello, QT. How much of a difference is that going to make?
Well, I think it really remains to be seen, because what is very uncertain is how much of the higher bond yields we've seen year to date is in anticipation of QT versus the actual action of it. We start today. We think that the Fed has left the door open to be able to accelerate the movement to the full $95 billion a month. But we really don't know how QT will affect this bond market, if we'll see a really big push in longer end yields. And so I think we'll have to watch that closely, because if yields start to roll over and yet we're still doing QT, what is the bond market saying about growth? And I think that's where risk assets could find another challenge.
Ashok, any lessons at all from 2018 in that period when it comes to QT?
Yeah, I think for QT this time around, the Fed is obviously well telegraphed that, as well as the hiking cycle. So, the Fed will be taking down its balance sheet by, it's going to be about an annual rate of over $1 trillion a year, really starts in the fall in September. So, our sense is that balance sheet unwind, a lot of the spread widening we've seen in various asset classes, and partially the rise in rates is just anticipation for that. So, our sense is it's closer to fully priced than unpriced.
Ashok, do you have confidence as to whether it is positive for Treasuries or negative for Treasuries based on what we have seen?
I think for Treasuries, it's going to be, more or less irrelevant. Our main view is this first half of the year for bonds has really been about rhetoric. It's been about the Fed wanting to reset the hiking expectations, which they've obviously done pretty successfully. But we're now entering a transition zone. In the second half of this year, and particularly the next few months, we're going to be much more driven by the data. If we see, as we expect, weakening on the job front, weakening on the inflation front, rates and credit are going to find some footing at these levels. But it's really about entering a more of a data-driven market than a rhetoric-driven market. And in that sense, if the data cooperates, I think QT and such will sort of move to the background pretty quickly.
This is what Citi said this morning. They said yields haven't peaked, equities haven't bottomed. They went on to say, despite signs that upside inflation momentum may be slowing, yields tend to not peak until well after inflation has peaked, especially when the starting point of the inflation peak is so high. Cameron, your thoughts on that quote there, your reaction to it, do you agree?
I do agree, because I think that even if we see the headline or the core number peak on a year-over-year basis because of base effects or tough comps from last year, the reality is that inflation is so broad now. Back last year, only 20% of the components in the CPI were above 4%. Now that's 80%. So even if a couple things start to roll over and bring that headline number down, the reality is that inflation is so broad, and the Fed looks at that. They look at something called the trimmed mean CPI. It throws out the extreme readings on the top end and the bottom end, and that remains very elevated at a 40-year high. So even if we see those headline numbers roll over, it really isn't enough to warrant a full dovish pivot by the Fed, because the labor market still remains so tight. It might be softening or easing some, but we're coming off of record tightness. Powell called it an unhealthily tight job market at the beginning of this year. So some easing really isn't enough to warrant a dovish pivot.
The high of the year, 320 on a 10-year in early May. Ashok, the degree of confidence you have that might be the high of the year for the rest of the year?
Yeah, we're putting that at about sort of 70% odds. So I think it's better than even that this and sort of call it the 280 to 320 range is where bonds are going to find a footing. And, the view on that, you mentioned the Citi quote. I mean, we're a little bit more optimistic that we'll see a little bit faster decline in inflation. Certainly it's going to still be elevated. We'll see a little bit more weakness in wages. We're already starting to see that. So the macro environment we see is probably a little bit more supportive for fixed income than maybe consensus here right now. There is a chance, right? I mean, inflation, there's a lot of risks associated with it, and specifically on the commodity front. So I think there's, 1 in 3 type of chance that we're going to see something maybe around 350. But, we've been putting cash to work in these markets and various asset classes in this broad range and in 10-year notes.
We'll talk about where you've been putting cash to work more specifically in just a moment. 25 minutes out from the open and bound. Futures are positive by about 0.4% on the S&P. Katie Lyons, looking back on May, I have to say it didn't feel like a flat market, but on the S&P, that's what we got.
Yeah, literally almost exactly unchanged on the month of May, even in spite of all of the volatility we saw over the course of the month, John. A whole lot of drama to go basically nowhere. The question now is, where are we going to go in June? Because as you were just discussing, finally the start of QT, persistent growth and inflation concerns, a war still raging in Ukraine, fueling those. Not a great cocktail heading into a month that historically isn't great for the equity market. On average, since the year 2000, June has brought with it a decline of about 0.4% on the S&P 500, the third worst month out of the year. And we have to consider how far we've already fallen coming into this month. The S&P 500 down about 13% year to date, its worst start to a year since 1970. And looking back at starts that rough over the course of history, 4 out of the past times we've seen losses of that size by this point in the year saw the index end the year lower. Interestingly, the one exception was in 1970, but even then it only closed higher by about 0.1%. And of course, back in 1970 and the years following it, we know that there was a pretty sizable inflation problem in the U.S. economy. We are facing an inflation problem in this moment as well. And in part, that stems from higher commodity prices like oil driving up gas prices at the pump for American consumers. And that potentially is poised to get worse, with inventories at 50% of normal levels. And they tend to fall in the summer driving season as it is. So that could mean more price pressure on consumers who may start to change their behavior, become less tolerant of higher prices. That raises the question of the ability of companies to exercise pricing power to retain profit. That comes back to earnings and the fate of this equity market, John.
A lot of drama on the road to nowhere. Kayleigh, thank you for that. Thank you very much. Ashok, just to come to you on that, your view on where you are comfortable taking risks. You touched on it briefly. Talk me through it.
So I think there's 2 broad areas. First is, high quality fixed income. I think, one of the underreported stories, in this environment has been, 4% types of yields, which for a lot of global bond investors is an important bogey. For the last few years, there was no way to achieve that without non-investment grade and emerging markets and bank loans. Well, suddenly with the rise in rates and widening spreads, things like agency mortgages, investment grade credit, short and intermediate term is offering those yields and more. So we've been deploying capital into those high quality fixed income markets like those 2. And then the second area is the non-investment grade market. The non-investment grade market is moving up in quality. And suddenly we find ourselves in an environment with the backup in interest rates where, double B, some triple B securities, 60 to 80 cents sort of price, dollar prices. That type of low dollar price credit instrument is the second area that we like right now. And, yields on offer there are anywhere from, 6 to 8.5%.
Cameron, from your perspective, how competitive is fixed income now? Pockets of it with the equity market?
I think it's far more competitive, mostly if you are a longer term investor and can lock in those yields. The thing that's interesting is that despite the fact that we have seen near term inflation, we haven't seen those long term inflation expectations blow out, which means that the fixed income market still rather believes that inflation will get back towards the Fed's 2% target. So it'll be interesting as we go into the Jackson Hole period, how the Fed talks about that 2% target, because that could be the one risk for fixed income looking forward, is that if the Fed starts to move away from that, do we see those long-term inflation expectations actually need to move higher, because they do surprisingly remain anchored.
We keep hearing about it, don't we? This idea of a September reset. I'll go through the dates for you. Fed meetings on the 15th of June, July 27, September 21. Before we get to September 21, you've got a CPI reading next week, June 10th, July 13th, August 10th, September 13th. 4 CPI readings going into that September 21 Fed meeting. Ashok, to you on that. I want your view on it. How you think we reassess things at this Federal Reserve in September? because there is this conversation fueled by President Bostic last week that perhaps they can pause after doing 50, then 50 again, then pause. Do you agree with that?
I think there's a decent chance we get that. I mean, we certainly think, Fed going 50 at the next couple of meetings, that should be base case, largely priced. But by the time we get to September, we're going to have three months plus more of data, and we're just all going to have a much better sense of how quickly inflation's moving off and what's going on with the labor market. And our best guess is that the data will essentially bail out the Fed, and by September, they'll be able to slow, elongate a hiking cycle, potentially pause. But it's really going to be, to state the obvious, driven by the data. But our sense is the data will give the Fed wiggle room to be thinking about a pause or a moderation in the hiking by the fall.
We'll keep talking about it. Ashok sticking with us alongside Cabra Dawson. Your market looks like this. Equities up about 20. No drama here. Up about 0.5% with your movers. Here's Abby.
Well, John, we certainly do have a nice bullish tilt here for U.S. futures. And one of the stocks helping out, Salesforce.com. Shares are soaring. This, of course, after the company put up a strong quarter. They also raised the full year profit outlook. Solid demand for business software remains in place. And JP Morgan saying that the management tone in the macro is much better than expected. Delta Airlines up about 0.75%, the company following in the footsteps of United Airlines and Southwest Airlines to raise the revenue outlook, saying that the demand is strong even with fares up. And of course, the second quarter adjusted revenue is fully restored to 2019 levels. So it's almost as though the pandemic had not existed for Delta Airlines right now. Really pretty impressive. ExxonMobil rising in sympathy with oil back higher again. ExxonMobil up 1.3%. And then Tesla had been down about 0.75% earlier, now down just fractionally. This, of course, as Elon Musk is saying that the return to office, that the employees of Tesla must return to the office or work somewhere else. And I will say New York City, just over the last week or so, John, I don't know if you're seeing this yourself, seems much busier than it had just a couple weeks ago.
You know why they were so frustrated over the last year? You'd see the restaurants downtown New York full at the weekend. Abigail, they'd come into New York for the weekend to be at the nice restaurants and then not come into New York in the weekdays to be in the office.
Yeah, it seems now, based on my look at Grand Central and Park Avenue and Lexington, just folks coming back into the offices finally. Midtown had been very deserted now.
Slowly.
Yes, encouraging.
Slowly. Abby, thank you. Thank you very much. We'll catch up with Ed Ludlow a little bit later on about that line from Elon Musk. We did get some price target cuts from Goldman this morning. I'll go through them later on Ford, on GM, on Tesla too, on two things: additional supply chain troubles in the near term, weaker demand in the intermediate term. We'll talk about that a little bit more a little bit later. Coming up next on this program, President Biden passing the buck on inflation.
My plan is to address inflation. It starts with a simple proposition: respect the Fed, respect the Fed's independence.
That conversation up next.
My plan is to address inflation. It starts with a simple proposition: respect the Fed, respect the Fed's independence. They have a laser focus on addressing inflation, just like I am. And with a larger complement of board members now confirmed, I know we'll use those tools in monetary policy to address the rising prices for the American people.
Over to you, Chair Powell. President Biden passing the buck on inflation. Secretary Yellen issuing a mea culpa.
I was wrong then about the path that inflation would take. As I mentioned, there have been unanticipated and large shocks to the economy that have boosted energy and food prices and supply bottlenecks that have affected our economy badly that I at the time didn't fully understand.
We need to get to AMH down in D.C. Anne-Marie, credit to Secretary Yellen, stepping up, standing there and saying, I was wrong.
Yeah, a lot of people got it wrong, right? Including the Fed chair, Jay Powell, who the president has now said it is fully his responsibility to fix. Also, yesterday, Jonathan, in the briefing room after that meeting, Brian Deese, the president's head of the National Economic Council, came out to brief reporters on the meeting on inflation and was asked as well. Said, sir, you stood at this podium telling us this was going to be temporary. And instead of owning it the way Janet Yellen did, really deflected and also pointed a lot of attention to how uncertain this was coming out of a pandemic, but also the fact that this is a global problem. Look at Europe. They're dealing with north of 8% inflation as well. So clearly, Jonathan, you see the administration really coming out aggressively that you're going to see more of this as well for the month of June to pivot towards tackling the issue of the economy. But the question is it so much going to be in different policies or more about the messaging? And so far, it's really been the messaging. The president, 24 hours, 2 op-eds, Wall Street Journal, New York Times. He had a meeting with the Fed chair. He's going to be meeting with suppliers for infant formula. There's going to be a lot of different messaging, and very aggressively so for the month of June, because when you look at the polls, and one recent one said 9 out of 10 of Americans, out of a minimum, say inflation is the biggest concern, and they don't like the way the Biden administration is handling it.
You said it. Let's unpack it piece by piece. We had an op-ed in the Wall Street Journal on inflation. We had an op-ed in the New York Times on foreign policy, a mea culpa from his Treasury Secretary. You can throw in the fact that he sat there with the Fed chair, and not so subtle, it's them, not us, about inflation with the Federal Reserve, and an NBC report in the last 24 hours suggesting this president is increasingly frustrated with his own administration and the people around him. As you pointed out, Anne-Marie, is this going to be about policy or messaging going into the midterms?
Well, at the moment, I think a lot of this is about messaging, right? One of those nuggets in that NBC report, Jonathan, said the president is incredibly frustrated where he comes out and he says something and then only for his own aides to then walk it back. So there does seem that there are a lot of questions around potentially is there going to be any shifts in the administration. The NBC piece talked about potentially with the White House Chief of Staff, Ron Klain, maybe after the midterms. That would be a more traditional path of a lot of presidencies. After 2 years in, after a midterm, sometimes there is a change of course, but it does look like our changing course at the moment ahead of these midterm elections, where this is the #1 issue for voters to change the communication on inflation. When it comes to policies, they say that they are doing everything they can, but then you question, are they? We asked Brian Deese yesterday in that briefing room. Reporters asked him, sir, where are we when it comes to the China tariffs, which some economists say could shave off some inflation? And they said, I don't have an update for you on that. So there are a number of policies that have been floated, but then they've not actually followed through, that some say could impact the inflation story right now.
Anne-Marie, thank you. Related to this story, the price target cuts that we're seeing over at Goldman on those 3 automakers, Ford, GM, Tesla, this is what they had to say. Supply chain troubles in the near term, weaker demand in the intermediate term. On the demand story, they said key metrics that correlate with auto demand, housing data and consumer sentiment have slowed. The analyst added, PMI metrics like the ISM index and consumer demand data points have also weakened. Ashok, I want to come back to you, and thanks for being patient as we work through some of this. Your thoughts on where the automakers sit now in the credit market for you, given what could be happening with consumer here in America?
Well, from a credit perspective, the automakers are still in good shape. And I think it speaks to, this cycle, COVID hits and companies really, they raised a lot of cash, improved balance sheets, extended maturities. So they entered this year with actually, just as a general statement, stronger balance sheets and better looking from a bond perspective than they did 2 years ago. And then, typically we would have seen that cash get used and balance sheets deteriorate. But the events that happened with Russia and Ukraine and the Fed hiking, starting a hiking cycle in March, happened so quickly that companies really never had an opportunity to use that cash on balance sheet. So we're actually very comfortable with where autos and other industries sit from a credit perspective. And a lot of it is the improvements that happened over the last 2 years are still there and will ultimately, I think, stabilize this credit cycle, however it turns out, with lower defaults, lower downgrades than we typically see in a cycle.
Cameron, tell me, how does the same story look from the equity side?
Yeah, I think the equities are really starting to sniff out that there could be some challenge for the consumer because we are seeing demand destruction, or at least early signs of it, for high ticket price, sort of larger purchases, and also those interest rate sensitive parts of the market like housing, like autos. And I think that the reality is that the consumer is finally getting to the point that they're becoming much more stretched. If we look at real wage growth, it's actually been negative since April of 2021, which means that but consumers have been losing purchasing power for a year. Now, this wasn't a problem early on because we had child tax credit, we had supplemental unemployment, and we had high savings balances. But now we're at the point where you don't have benefit from the government, you don't have that high savings balances, people are having to spend down, they're turning to credit to bridge the gap between what they want and what they can afford. And the end result is that we're likely to see more belt tightening because of high energy prices, because of high food prices, really eating into the ability for people to spend on discretionary items. And so that was the story from this earnings season as you start seeing the early signs of that belt tightening.
Cameron, just quickly, do you worry that these supply chain issues will get fixed just as the demand starts to disappear?
Yeah, I used to be a cyclicals analyst, and that always seemed to be the time is that you would see inventory builds right into the peak of the cycle, just as you're starting to see demand start to roll over. So that certainly could be the challenge here. And I think it'll speak to or put pressure on possible pricing power for these companies, because the problem that we have is that prices are remaining very high, or cost inputs are remaining high. But as demand starts to slow, they lose the ability to pass on those higher costs to their end consumer. And that's where we're seeing margin pressure. So margin pressure, I think, really is the story for the remainder of this year, because if you look at estimates for EPS growth, a lot of the upside comes from margins going to a record high by the end of this year, and that's likely too optimistic.
So many companies caught wrong-footed through this cycle. Cameron, great to catch up with you. Thanks for being with us today. Cameron Dawson there. Ashok, Bhatia, thank you to you, sir. Coming up, the morning calls, and later, Morgan Stanley slashing price targets on a number of US tech companies. We'll catch up with BlackRock's Boivin around the opening bell. 5 minutes from the opening bell, equities doing okay, up 0.6%. That's your price action. Here are your morning calls. RBC Capital upgrading Danaher to outperform, seeing an opportunity to own a high-quality defensive stock at a reasonable price. Next up, Goldman cutting its price targets on Tesla, Ford and GM, highlighting supply chain headwinds and weaker demand. And finally, Morgan Stanley slashing price targets on a number of tech giants, cautious amid growing signs of an economic slowdown. Coming up, BlackRock also cautious. Boivin saying the equity rally isn't sustainable. That conversation and your opening bell up next. We closed out the month of May positive 0.01%. You can't make it up sometimes. The numbers speak for themselves. It did not feel that way, that's for sure. Futures right now positive about 0.6% as we kick off the month of June. On the S&P, on the Nasdaq 100 positive about 0.7%. We kick off the month of June right now. Switch at the board and get to the bond market. We look a little something like this on a 10-year yield. In America, Treasury yields pushing just a little bit higher by half a basis points to, let's call it 285, 284.95, and then we turn to 285. Euro dollar 107.24, negative about 0.1%. Deutsche Bank out with a fascinating call on the ECB. They think in Q3 the ECB goes twice, and one of those moves is a 50 basis point rate hike. We'll touch on that a little bit later in the week. Crude up by almost 2%, 116.89, whipsawed by that Wall Street Journal report from yesterday, suggesting that perhaps OPEC Plus could drop the plus, go negative. Russia ultimately come to their own deal on production, boost production, crude lower. You get the picture. And that's why crude yesterday backed away from 120. I think the higher session 119.98 yesterday. Looking at the open today, up about 0.6%. Information technology top of the pile, up by 1.1%. Materials and financials with some relative underperformance. The financials up by only 0.1%. With more, here's Abby.
John, well, definitely a nice tailwind here for stocks for the start of June, and a piece of it, the airlines. Of course, we have Delta Airlines following in the footsteps of United Airlines and Southwest, raising the revenue outlook. Demand staying strong even with fares up. Americans determined to take their vacations. In fact, they see their second quarter adjusted revenue fully restored to 2019 levels. ExxonMobil up 1.5%, as you were just mentioning, the possibility that OPEC will drop that plus or exempt Russia from from its targets. You see oil higher, as you were mentioning, and ExxonMobil going along for the ride, up 1.5%. Salesforce.com really outperforming, up 11.4%. The enterprise software company raised their full-year profit view. Demand for business software solid. And JP Morgan was impressed by the management's tone, saying that their color on the macro stronger than expected. Finally, General Motors, you've been talking about that Goldman cut to price targets. You see General Motors not paying attention. The investors bidding it up 1.6%. They cut the targets, of course, on supply chain and demand risks, but it was a cut to 46 from 59. So a bit of housekeeping, and we will have Ward's auto numbers here in the U.S. for the month of May, looking at 13.7 million autos sold in the month of May here in the U.S., down just slightly from the previous month, John.
Just toning down the optimism on the year ahead over at Goldman on the automakers. Abby, thank you. About 2 minutes into this, we're positive 0.8% on the S&P on the session. On the year, we're down 12.6%. On the Nasdaq, on a session, up 1.1%. On the year, we're down about 22%. Big tech, very much hoping for a better summer following a rough start to the year. The sector's biggest names, the Fang Stocks, racking up some major losses through the month of May. On the West Coast, let's get to Ed for more. Morning, Ed.
Yeah, good morning, John. The Fang stocks have been a focus, and as we sort of head to the midpoint of the year, you look at all corners of the technology sector, and they're not all created equally, right? You look at the NASDAQ 100, the Philadelphia Semiconductor Index, some of those mega cap tech stocks included within those baskets, both down more than 20%. But really, it's the more speculative and risky areas of the market. I look at the Goldman Sachs non-profitable tech index down almost 50%. You look at the names within their higher multiple software stocks. Some of the pandemic era winners like Uber also within that basket. I gave a smile at the close last night, John. I enjoyed it. I haven't seen that in my career. Flat in the month of May on the S&P 500. We narrowly avoid the bear market, but we've already seen bear markets in other indices, right? Particularly tech-focused ones. The NASDAQ 100, as you and I have discussed in the last 24 hours, the narrative is building that there's legs to run more on that bear market in big tech. We're in a position now, and I saw this throughout the session on Tuesday, where yields are rising, right? We see this shift to value stocks outperforming growth in a big way, not just in the moment, but over a historic precedent basis as well. The concern that your guests keep raising is, does this change with the inflation picture as it is? How do these non-profitable companies in the tech sector in particular fare?
You know who wants to see a bear market? Elon Musk working from home. This is what he had to say. You've read this already. I'll share it with our audience who haven't seen it yet. Remote work is no longer acceptable. Musk went on to say anyone who wishes to do remote work must be in the office for a minimum, and I mean minimum, of 40 hours per week or depart Tesla. This is less than we ask of factory workers. Ed, your view on how this is playing out?
That was a very good Elon Musk impersonation, John. Well, look, he's been consistent throughout from the early days of the pandemic, right? He fought very hard to keep Fremont over the water from where I'm sitting open. At this time, they're moving mountains to keep Shanghai running amidst those Shanghai COVID restrictions, which are now easing. The biggest line for me in that quote in the memo was, he will personally approve any exceptions to the rule. And last I checked, Tesla had more than 100,000 employees worldwide. So you can imagine how busy his inbox is going to be over the next 5 days. I think that's going to be
filling up pretty quickly. I just wonder how Twitter is feeling, Gad. Can you imagine the tech world of Twitter, of Elon Musk, if he does get his hands on it?
Yeah, look, Twitter internally, employees are discussing this day in and day out about what the company is going to look like, about the culture of the company. They're referencing recent reporting and allegations against Elon Musk around sexual harassment. We have some reporting coming later on the Bloomberg terminal about some of the product changes that may be changing at Twitter, right, with a view to what Elon Musk might be focused on. But internally, for these employees and these software engineers, it's still a great unknown.
Ed, looking forward to your reporting a little bit later. Thank you, buddy, as always. The pain in big tech, then, may be far from over. That's the view from the team over at Morgan Stanley, slashing their price targets on Amazon, Alphabet and Meta amid growing signs of an economic slowdown. Back with us for more. Here's Katie.
Yeah, John, Brian Nowak and his team saying that the odds of a recession here in the U.S. are now up to about 35%, up from about 5% at the start of the year. And they say that could spell bad things for advertising and e-commerce growth, which is a bad thing for a number of these tech names. They slashed their expectations for online ads and e-commerce growth by about 1 to 4% for 2022 and 2023. And also, as you said, sizable price target cuts for the likes of Snap and Pinterest. Snap's target cut 56% down to $24 a share. The cut for Pinterest was about 25% down to $21. And you also had some sizable cuts for the larger players as well. Now, to some degree, this is a game of catch up because as Ed just ran us through, these stocks have already seen a lot of pain so far this year, all of them down 20% or more. And that has knocked trillions of dollars in value off this equity market and dragged the NASDAQ 100 into a bear market. Global tech more broadly heading for its worst annual performance in 14 years, since all the way back in 2008. Obviously, though, these stocks are now much cheaper. The forward PE multiple on the NASDAQ 100 is now about 21. That is the third below its height in 2020 and below the 5-year average of 23. So these stocks are cheaper. Valuations maybe look more attractive for dip buyers. The question is, how many people want to dip their toes in this water with all the headwinds still out there, John?
Kelly, thank you. Seemingly some today, at least. On the S&P 500, up 0.8%. On the NASDAQ, up by 1.2%. Just yesterday, we caught up with Savita Subramaniam of Bank of America. Take a listen to this.
Maybe we're not at the absolute bottom, but there are some areas within the equity market that are likely to be, some of the best opportunities, some of the best entry points that we'll see in this sell-off. So equities offer inflation protection and cash return. Where can you get those things? Well, a lot of equities have them. Energy, financials, even healthcare staples.
Let's get the BlackRock view from John Boivin. John, great to have you with us on the program. You've toned down your view on equities recently. Just walk me through the thinking.
Great to be with you, John, this morning. Thanks a lot. So the main, it's all about the policy landscape and the Fed in particular, I would say. We have been, overweight equity by a lot of the arguments we've just heard about. Equities are attractive in an inflationary environment and will continue to be, but there's been a significant repricing of the policy path in the US over the course of the last few months. Very significant. We don't think that ultimately that policy hiking will be fully delivered. But for the time being, the Fed is really playing for the inflation, politics of inflation. And until that changes, I think we're going to be in an environment where, it's difficult to see, a buy the dip mentality working out. I think we're gone the days of just simply buying the dip. It's a different kind of environment. And so we'll need to have clearer signals on how the Fed is framing this environment before we see, a more constructive rate landscapes supporting equities.
John, you were previously overweight. There might be some people, they might be rude, they might turn around and tell you this is like closing the barn door where the horse is already about 2,000 miles down the road. What would you say back to him, John?
Well, I think we're adjusting to a pretty significant backdrop that has changed in terms of the rate side of things. I would say, our biggest conviction underweight was on fixed income government debt, which we thought yields will have to go up. We still believe they have to go up from here. So that has played out partly in the long end where we think that has more to continue. There's been more noise now on the Fed front, and we're acknowledging this. We think ultimately central banks will have to pivot to a more dovish stance. And as a result, we will see eventually a more constructive environment. But right now, we think it's better to be neutral. Just to be clear, we're falling back to neutral, staying invested, but neutral. And we think they're going to be better entry points, still over the next few months until we get clarity.
On the central bank story, here's the quote on the Fed from you and the team. You said the path of short-term rates is less than what the market is pricing in now. That's what you expect. On the ECB, you say we see the path of market pricing too aggressive. You see that both at the Fed and the ECB as well. You mentioned there that they might have to pivot. So let's talk about that, John. What's going to trigger that move? What's in the path forward, in your view, that you think triggers that move?
Well, I think it's important to maybe take a little step back to see why we think of this way going forward. But last year, we had commentators and the Fed, I think, central banks in general, oversimplifying the story of inflation with framing it around a time frame, right? Which was temporary, which we don't use anymore. That turned out to be wrong, could not be sustainable as a story. So we shifted away from that. But unfortunately, I think we've shifted to an oversimplified story again, which is one where we're going to raise rate until inflation is under control. But that's trivializing the world we're in. The cost of bringing inflation quickly back to 2 would be extremely acute, high. And I think that's going to become clearer over the next few weeks and months. And as this becomes clearer, I think there will be no choice but to acknowledge a trade-off that is not as simple as simply raising rates until inflation is tamed. So that's the trigger, is like acknowledging these costs, which will be pretty real and will come clear over the next few weeks.
So, John, this is really, really important. Fading the tightening story at the Fed isn't necessarily good news. It can mean inflation is coming down because the supply side surprises in a positive way, or it can just mean the economy can't handle it. So, John, just be more specific for us. Which one is it, and what implications does that have for how you allocate capital?
So we don't think there's a nice Goldilocks scenario in the middle, which I think is what you're getting at. I think either we're getting a world where we're slamming the brakes, we're insisting on getting inflation back to 2, which I think is a world where we're going to see a recession. I don't see any homegrown reason or endogenous reasons for a recession to happen. It's not a typical recovery that leads to a recession, but if the risk of over tightening could be leading us there. The alternative, which is what we think is going to be ultimately the most likely scenario, is we're going to live with somewhat more inflation. So it's not a great scenario. It's not like a Goldilocks like we might have seen over the last 20, 40 years, but it's one that I think is more benign than a recession one. And that's why we expect a bit more inflation than the market is expecting. We see rates going not as far up ultimately, but at the same time, lower cost in terms of economic activity.
So, John, coming into this year, my thoughts on fighting the Fed. A lot of people would say, don't fight the Fed. And I had to think about, well, what does that mean for 2022? And what I thought it meant would be inflation protection would no longer be needed because this Fed doesn't want inflation anymore, and ultimately means higher real rates. Are you saying we can fight the Fed? We can fight that effort because ultimately they won't be able to succeed without causing a recession?
Pretty much, that's what I think we're saying here, is that it's going to be very difficult to tame this inflation, bring it back to 2 quickly. And it's not something that is caused by, a monetary policy itself. Interest rates themselves are not really addressing the root cause of what we're dealing with right now. Massive reallocation shock between goods and services, the biggest we've ever seen in terms of sectoral reallocation. That won't be solved by tightening policy. I think that's going to become clear. And if we try to do it, it's going to be extremely costly. And so I think that's what, don't fight the Fed or fight the Fed, I don't know, but it means not buying the idea that inflation will fall back quickly to 2% and connecting that to rates rapidly increasing.
John Boivin of BlackRock. John, stick with us. We've got some data out in just a couple of minutes, and Mike McKee's going to drop by and break it down for us. John, thank you. We are positive by about 0.5% on the S&P 500, on the Nasdaq higher by about 1 percentage point. Coming up just around the corner, jobs day in America and a ton of economic data.
The Fed's pretty convinced that they need to go to something close to neutral, and expeditiously is the way that they put it. And so that's what they're doing. I think that the economy is going to have enough momentum to keep the Fed, so the Fed will keep going into the fall.
That conversation up next.
The Fed's pretty convinced that they need to go to something close to neutral, and expeditiously is the way that they put it. And so that's what they're doing. The notion that at some point they're going to take a pause and look around, of course that's going to happen at some point, but it's going to be driven by the economic data. I think that the economy is going to have enough momentum to keep the Fed, so the Fed will keep going into the fall.
Bill Dudley there, the former New York Fed president. On the economic data, let's get to Mike McKee. Morning, Mike.
Good morning, John. Some fresh data coming in from S&P Global. It's U.S. manufacturing PMI out. And as is the case around the world today, it's basically a story of stabilization, with the number coming in at 57, down from 57.5. However, a little bit less than the market thought, but it doesn't really matter all that much. It's a kind of a rounding error in this case. And it does suggest that the manufacturing business has stabilized. Of course, top of the hour, we'll get the ISM number, and that'll get a lot more market attention. But around the world, same story. We've had some slight changes in the manufacturing ISMs for Germany, France, Italy, the Eurozone, and the Euro-K. Some up, some down a little bit, but all still in the 50s, all still suggesting manufacturing is expanding around the world, and that's what the central banks want to see as they are raising rates. Rest of the week is going to be interesting. Here are the most important things that we're watching. The ISM, as I mentioned, we'll also look at the prices paid as part of that. Auto sales are those starting to be affected by higher interest rates. Jobless claims, everybody's canary in the coal mine. And then, of course, Friday is Jobs Day and ISM services. I mentioned at the bottom there, the Fed balance sheet. This is June. We're starting the balance sheet reduction this month. Doesn't really start until the 15th when the first bonds start to roll off, but people are going to be watching. Nothing's going to really happen or change in the markets, John, for some months because we're talking such huge amounts of money, but it does begin this month.
It's finally here, and you asked the chairman himself for the news conference, why did we wait so long, but we can go there another day. Mike, JOLTS data, it's taken on this new importance. What do you make of that?
Oh, it's just people trying to figure out where the Fed is going. And the Fed is, we know, going 50 in June and July, they say, unless they come out and change their mind. So then what happens after that? And there's a feeling that the jobs data will help them make a decision because, as Bill Dudley was pointing out, the Fed is probably going to be pushing the unemployment rate up. It's been going down. It's forecast to go down again. So when do we start to see a change in the employment situation because interest rates are higher? That will give the Fed a clue as to how their medicine is working.
Mike McKee, thank you, buddy. As always, going through the data, the PMI behind us, ISM coming out in about 10 minutes. You get JOLTS data, job openings in America as well. On to tomorrow, we get ADP, jobless claims. I think we get some factory orders, durable goods, capital goods orders in the mix as well. Then onto payrolls Friday. Jean Boivin waiting patiently for us. John, thank you for that. Let's frame the debate with the Fed. And we know your view now. You've got the one side of the conversation, the debate, the argument that the Fed is going to keep on going. Think Bill Dudley. He thinks the economy is resilient. They'll have to do more. Your view, the Fed takes a pause. I often think about this, often ask this question. How and when would you know if you're wrong? Where on the calendar can you identify when this argument gets settled one way or the other, Sean? Where is it?
I think they're going to 2.5 or close to that level by the end of the year. We'll see. We'll get a better sense as we get closer whether like this is close to what we think is neutral. We've already seen like a pretty sensitive market to this repricing of rate hikes. So I think this is a sign that like we'll get more and more evidence that like neutral might be, not that high in this cycle. But I think by the year end, we'll get to that point where the Fed has framed things around two phases. We're going to try to go back to neutral swiftly and then reevaluate. And that's going to be then a question about what we do next. And I think this is coming into sharper relief, by the year end. And so that's the horizon we're looking at. Getting close to neutral as quickly as possible. I think that's a kind of a 2.5 number that we are looking at. And once we're at that number, reevaluate.
John, just to lead on your central bank experience, as you know, it's impossible to know where neutral is in real time. Monetary policy operates with long variable lags. You know that quote. We use it all the time. John, how do we know any of this stuff where neutral is, and ultimately, do we find out too late? And if it's too late, we've already made a mistake, haven't we?
Well, I think one of the things I find a bit troubling in this environment is that we've completely lost this story about being forward-looking when it comes to central bank. All of the communication is kind of backward-looking. We've talked about framing things like we're going to hike until inflation is tamed. That's an example, right, of where by the time we know that, it's going to be too late. We're going to have overdone it. So there's a bit of a worry here of being in the mode of backward-looking policy making, and I think also solving for politics. I think where the politics of inflation is really like the driver here. And there's a bit of a rear view mirror here, story that is at play. But I do think that we won't never know whether we're at neutral, but we'll see sign of pressure cracks that I think will be more apparent, and they'll start to build a narrative around that, and we'll see some part of the committee making these arguments more forcefully as we get closer to the end of the year.
We've got to leave it there. Great to catch up, as always. Jean Boivin, there of BlackRock. We saw the politics of inflation on full display in the last day or so. Your equity market's positive by 0.5%. Your trading diary is up next. 26 minutes in, stocks are higher. Here's your trading diary. ISM manufacturing numbers coming up at the top of the hour. Some Fed speak from President Williams and Bullard following the Fed beige book a little bit later. President Biden meeting with baby formula manufacturers at 2:45. Another round of jobless claims on Thursday, and rounding out the week with a big one, the payrolls report. Job openings a little bit later too. Ton of data this week from New York City. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.